SoFi has had a roller coaster 2022 so far, with the stock being down over 63% year to date in one of the worst macroeconomic conditions in decades, with the student loan moratorium hindering the business and earlier this year even struggling to secure a national bank charter. In this channel, we've covered every major catalyst and news piece around SoFi since their SPAC merger, and in this video, I wanted to take a moment this Labor Day weekend to talk about 5 of the most common bear cases or biggest objections that I've been hearing to SoFi stock, along with some rebuttals and catalysts going into the end of the year and into 2023. If you hold SoFi and want to learn more about the stock, or if you're skeptical on buying SoFi or even bearish on the stock, this video might be able to provide some value for you. Let's get into it. Okay, so there's a lot to cover in this video. I'll run through the objections and throw up some supporting numbers, some charts, and of course, remember that I've done deep dives on many of these topics before. My most recent deep dives have been on the student loan forgiveness and the refinancing situation that's going on most recently, along with Softbank selling their position in SoFi. But before we go into the first bear case, let me lay out where we currently stand with the stock. SoFi is down 63% year to date. SoFi stock is actually trading at their book value. If we look at their latest quarter, end of June when they reported, they had $12.6 billion in total assets versus $7.1 billion in total liabilities. And if we subtract those numbers, we get $5.5 billion left over. And if we compare it with their market cap, as of this recording, that's $5.3 billion. Now, of course, I understand that price to book is a misleading valuation metric, but at 1x, basically, you're buying the stock for just the assets that they have on hand. In other words, SoFi is cheap. Per their latest reporting, Q2 2022, here's some other important numbers to keep in mind. Members grew 69% year over year, products are up 79%, adjusted net revenue grew 50% or 57% on a GAAP basis, and SoFi has reported 5 consecutive quarters of record revenue. Okay, so now that we've set the baseline, let's go into some of the most popular objections. One of the most common objections that I've been hearing is that SoFi is just a student loans company. In the backdrop of the student loan forgiveness decision over the past several weeks, Bernie Sanders came out and tweeted criticizing SoFi's CEO compensation and the amount of money that they've spent branding for the SoFi Stadium. However, the baseline understanding, the foundation of this tweet was referring to the company as a student loan refinancing company. And many people still see it this way, and I understand why. It's one of the core misconceptions around SoFi's business as it stands, and it contributes to the company's inability to command a tech multiple. SoFi is seen by half of the market as a refinancing or a lending company, competing with traditional lenders, competing with the big banks, the legacy institutions, and it's also seen by the other half of the market as a fintech platform, competing with the Robinhoods, the Blocks, the Affirms of the world, these tech platforms with modern solutions. And the truth is somewhere in the middle for the business. SoFi traditionally started out as a lending and refinancing company, and while there's still a big portion of their revenue in lending, they have really diversified their product offerings. I mean, from a product offering perspective, they have personal, home, and student loans in their lending segment. They also have SoFi Money, SoFi Invest, credit card, referred loans, SoFi at Work. On their technology platform, they have Galileo, Pagaya, Technisys, powering other fintech companies like Robinhood and Chime, for example. And if we just look at the products for their latest quarter, Q2, they reported 6.5 million products, up 79% year over year. However, student loans was only 462,000 products, up 10% year over year. And this comprises of only 7% of total products. So while student loans may contribute to a bigger portion of revenue, from a product perspective, I think it's unfair and wildly inaccurate to call SoFi a student loan refinancing company, because student loans are only 7% of their total products in the second quarter, especially in 2022, since student loans saw a big headwind in terms of the moratorium. And even if this number goes up after the moratorium is over, it's still going to be a number under 20% because their product offering is so much more diversified today than it was maybe in 2018 or 2017 when they were predominantly a student loan refinancing company. And so SoFi is completing this flywheel essentially of financial services products as well as lending products. In keeping with the same tweet by Bernie Sanders, the next critique or the bearish point was around CEO compensation, and overall stock-based compensation has been a pretty big topic a pretty big objection that bears have been bringing up with regards to SoFi. Yes, the CEO compensation is high, especially for an unprofitable company. I'll be the first to admit that. I'm not going to sit here and defend $103 million total compensation for the CEO. In fact, many of the executives at SoFi have very high compensation, although the overwhelming majority of this compensation is stock-based. So for example, Anthony Noto, 98% of his total comp is stock awards. Now, this is positives and negatives, right? The negative is, of course, that it is dilutive to other shareholders. And the positive is that it doesn't necessarily affect the company's cash flow the same way that a salary might. Now, the flip side of this is having high levels of compensation ensures that your executive team, number one, is the best of the best, is top talent, and number two, has skin in the game. They're incentivized to grow their business because their own net worth or their own compensation is directly tied to the business's performance. So that's definitely one part of the objection. The other point is, as I was doing my homework on this topic, there's some really highly paid CEOs out there, and SoFi is not really alone in that fact. They're not even the wildest in terms of how much they're paying their executive team. For example, if we take a look at this list, we can see dozens of CEOs that are higher paid than SoFi, and many of them are leading unprofitable companies. I mean, look, Robinhood is one of the companies that the market sees as a competitor to SoFi, and their CEO is getting wildly more money than SoFi's CEO is. Stock-based compensation is dilutive, I understand this, but it's also important to retain top talent. It also drives the business higher. And these are two things that you have to weigh against each other. How dilutive is it in the short term, and how much does it actually correlate or contribute to higher business performance in the long term? SoFi paid more than $80 million in stock-based compensation in the second quarter, or roughly 22% of total quarterly revenue, and more than $157 million in the first half of 2022. Total stock-based compensation in 2021 was $239 million. And look, paying out $157 million in stock-based comp over the first half of 2022 is already a big number. This is definitely a negative to the business, but as I've stated, there are silver linings to this because it incentivizes people to be aligned with the business's growth and it retains top talent. And look, coming from a tech background myself, this is very normal because the biggest companies out there who have the deepest wallets, they're going to be competing for top tech talent. And it's very difficult to find competent tech leaders who have a vision for the company. And if you do find those people, compensation is one of the three ways you can tempt them, right? There's compensation, there's believing in the product, and believing in the company's direction is the main ways, right? So total stock-based comp is definitely a negative in the short term. I'll be the first to admit that, but in the long term can contribute to higher business performance. And SoFi has been growing very strong as a result, I think, of their team. So to the extent at which it is incrementally beneficial in the long term is yet to be seen, but it's definitely a negative in the short term. But there are two sides to that story. It's not just, this is a negative, therefore I'm not investing in SoFi. Just my 2 cents. The next objection around SoFi is that they're unprofitable and that they're negatively impacted by this macro environment. Yes, this is the case. However, SoFi is growing at an incredibly high rate, especially in this macro environment. 50% revenue growth as of their latest quarter. They even raised guidance despite the macro environment being where it is. Compared to other financial institutions, SoFi is among the most reasonably priced, and it's among the fastest growing. So this chart that I'm putting up on the screen was created by Tanner Manson, who covers SoFi on his channel, Future Investing. I'll also tag his channel in the description. I think between the Fundamentals Investing podcast, which you're watching, Future Investing, and also Kyle on StockGoat, these 3 channels alone, I believe, have sufficient coverage around SoFi stock. They're all you really need to get up to speed on what's going on with SoFi. I believe between the 3 of us, SoFi is among our largest positions in all of our portfolios. And I definitely wanted to promote that because if there is some good content out there, that's definitely not competition. It's more awareness for a message that I'm sharing. So definitely check those channels out in addition to this one. But back to the video. In this chart, you can see the growth rate and the price to book ratios of several fintech companies. And what you'll notice is that the cheapest companies on this list are also declining in terms of their growth rate. And the growing companies on this list are not cheap. And yet you have SoFi as one of the cheap companies growing one of the fastest. So it's breaking this trend It's sticking out like a sore thumb in terms of other competitors out there. And there's several reasons for this, right? In addition to the banking charter that they secured earlier this year, they've already begun offering more favorable rates for checking and savings, 2% APY, compared to their peers, many of which are offering negligible rates. This is one of the most competitive offerings in the market. Their major growth headwind in the student loan moratorium is ending, and loans are set to resume in January 2023, which unlocks a huge portion of the business's revenue. And not to mention that in upcoming quarters, SoFi will see a surge in refinancing as they did in the fourth quarter of 2021. When student loans were initially expected to return, what happens is people rush to refinance at a lower rate as rates are continually going up. I talk about this more in depth in a video that I'll tag up here, but this is definitely a positive catalyst. And in addition to this, one other catalyst to watch out for going into the end of the year is options trading. SoFi does not currently offer it, but in the second quarter earnings call, Anthony Noto highlighted that the business is making progress and keeping on their initial timeline of introducing this product offering by the end of the year. Now, why is this important? Well, because number one, the demand for it is huge. For example, if we take a look at Robinhood, which is seen by the market as a competitor to SoFi, options trading revenue for Robinhood was 56% of their second quarter earnings. Simply put, options trading is an absolutely huge market that can be unlocked for SoFi very easily, especially when you consider the flywheel effect for SoFi, right? And I just want to pause for one moment on that cross-selling flywheel because I think options is going to work perfectly in this mix. SoFi is unique in the fact that it offers rates competitive enough to compete with large legacy players as a result of their bank charter, as well as a healthy diversity in product offerings to compete with lean fintech companies. It's sort of a middle player, it's a hybrid company. They have more products than they have members. Products are growing faster than members are growing, and the ratio of financial services products to lending products has been increasing every single year. This is an indicator that people love SoFi's offerings. It's an indicator that they have high trust and willingness to try more SoFi offerings in that ecosystem. And it's also where options comes in, right? You get the highest rates on checking and savings. You can buy fractional shares, you can trade crypto, you can soon trade options as well, and you can have a home loan or a student loan all in one. People love the fact that it's all living under one roof, all in one place. It makes their experience very seamless. It makes their experience very easy because at the end of the day, why would a consumer use 3 different apps or 3 different banking experiences when they can just aggregate that all into one? There is definitely value in that. That's been proven time and again. And SoFi is offering that as a hybrid option. So they're the best of the best from traditional players and from fintech players because they have a wide diversity of product offerings and they have the best rates out there as a result of their bank charter. The reason I mention it is because all of this contributes towards their profitability. EBITDA is already profitable for SoFi. Cash flow will be positive by the end of the year. Looking at the charts, looking at the catalyst that I just mentioned, looking at the guidance that the business is providing, we can see this trend very clearly. Profitability for SoFi is just a matter of time. It's not a matter of if, it's a matter of when. The fourth objection that I've been hearing around SoFi lately is around Softbank selling their huge stake in the company. Softbank sold something like 90 million shares. I made a full video breakdown on this. It's going to be attached up here. But at a high level, Softbank selling out of SoFi had nothing to do with the underlying business. It had everything to do with SoftBank's own financial situation, with the fact that they recorded a record net loss in their business, and also with the fact that they had to sell out of many positions, not only SoFi. As a matter of fact, from an institutional holding perspective, SoFi scored a 10 out of 10 on TipRank's Smart Score with a consensus buy from analysts and increased hedge fund activity. In fact, the top shareholders for SoFi have recently increased their holdings by big amounts. As the stock has fallen, they've all taken advantage of that. And the other point I'll make on institutions is a slightly more cynical one, because the same financial institutions that are giving SoFi their price targets are also competing with SoFi in many areas, right? So there is the potential for manipulation there, although I won't go so far as to say that there is clear manipulation there. It's just a clear conflict of interest because the competition is also the arbiters analyzing the company's performance, the appraisers essentially. But the flip side of that is that these same institutions are also the ones adding their positions heavily to SoFi. So Softbank selling had nothing to do with the stock. In fact, the data suggests it's quite the opposite, that institutions are adding to the positions, not selling out. Finally, the fifth and final objection that I've been hearing around SoFi stock is with regards to a reverse stock split. Given the stock's poor performance over 2022, many have been considering the possibility of a reverse stock split. SoFi has a couple motivations for doing a reverse split. First, the move would increase the stock price for SoFi stock. You would reduce the number of outstanding shares, thereby all other shares remaining in the market would have a higher price. This would broaden the appeal for the stock to institutions who might otherwise be prohibited from buying such a cheap stock. Secondly, it would also improve the perception around the stock. It's not going to be letting the company fall into penny stock territory. And just overarchingly, there is this conception from retail and also some institutional analysts that cheaper stocks are actually less valuable companies or lower quality companies. So having a reverse stock split and seeing SoFi stock be maybe $20 a share instead of $5 a share would be beneficial from a psychological perspective as well. Ultimately, the board are the ones who are going to decide whether this is the path or not. Historically, stock splits have been negative because they often represent the sell signal. Oftentimes, it's an indicator of a distressed stock, and generally the price falls shortly after the split or leading up to the split. And on this topic of a reverse split, I have a couple of points. Firstly, I don't think the board is going to do a reverse split unless the stock falls into $3 range or lower. And I don't think that's going to happen. I think we're seeing strong support in the $5 range. Even in our max drawdown back in end of May, beginning of June, SoFi hit $5 and bounced back from that. So I don't think we're going to fall to a level where it justifies a stock split. And the second point I'll make is looking more overarchingly, stock splits don't change anything with regards to the fundamentals. It's all short-term psychology for the stock. SoFi is not a distressed company. They are a sustainably growing company, whether they split or not. The only thing that changes is the sentiment in the short term, and that doesn't really matter as much, because in the long term, the stock price will always catch up to the business underlying fundamentals. I mean, the stock is already trading at book value. And so if it falls, let's say, into $3 range, and then we get a reverse split and it becomes $15 and it keeps falling, then that's just a further opportunity to keep buying because the underlying business is actually healthy. As I mentioned, do take a look at my other SoFi videos, as they will be beneficial in diving into the details around lots of the topics that I covered here. I wanted to cover the 5 biggest bear cases or the biggest objections that I've been seeing to SoFi stock and provide an alternate view to those, provide a somewhat more bullish take to those. Although I acknowledge that all of those 5 points are true, but there's a huge asterisk when assigned to it. The market is forward-looking and it prices many of these factors in. People can see past the short term to look at the medium and long term, which is very bright for SoFi. For more SoFi content, definitely follow the channel. I'll be covering the stock more closely in this channel. Also check out Future Investing and Stock Goat, 2 good channels on SoFi. They put out good content. I definitely want to give credit where credit is due. I personally have bought more SoFi stock this week. I think I bought in 2 tranches over the past week. I'm going to continue buying more for as long as it's under $6, under $7 even. I've been buying very heavily since the beginning of the year. My position in SoFi is almost 10% of my portfolio now. It is my second largest company. Could not be more happier with my stake. For right now, this is the Fundamentals Investing Podcast. Thank you so much for listening.